a sense of decency that's like a barometer to a man's or a country's health.
I have pushed that project. Fabio Panetta is working hard on that together with members in the entire Euro system, with a high-level task force that is working really hard on moving forward. But in a way, I'm really pleased that attention is now focused on the role that cryptos can play and the role that central bank digital currency can have.
She's really pleased the focus is on crypto and the role central bank digital currencies can play. You have heard her say nasty things about crypto in the past. She's going to go back and forth, and she's going back and forth for a reason. For that is CBDCs don't solve everything, and crypto asset networks are needed for this tokenized paradigm.
When they are implemented. We have a schedule, as you know. The Governing Council decided back in October 21 to launch a 2-year investigation phase. And it is at the end of that investigation phase that the decision will definitely be made to launch the CBDC and to make it a reality. We can't go wrong with that project. I'm confident that we will move ahead, but that's going to be a decision of the Governing Council. I think it's an imperative to respond to what the Europeans expect, and I think we have to be a little bit ahead of the curve if we can on that front. So if we can accelerate the work, I hope we can accelerate the work. I will certainly support that. And I was delighted to see that in the United States, there was an executive order by President Biden to actually expect similar effort and focus and progress on CBDCs, cryptos.
Lagarde is pleased about Biden's executive order and wants to accelerate the work on crypto and CBDCs.
It's the wrong one. It's the idea that the dollar is going down in value. But as we said before, the dollar keeps going up, not down. And so every time we have these periods where the dollar sort of goes down for a little bit, like in 2017, for example, everybody says, okay, this is the dollar crash. Here it comes. And everybody piles into crypto because they've been told you need to protect yourself against the dollar crash. But then 2018, the dollar continues to suddenly goes higher in the middle of 2018. And you think, well, wait a minute, the dollar didn't crash. It's going the other way. We're not seeing an eruption of currency. We're seeing the exact opposite. We're seeing deflationary money break out all over the global economy, and everybody piles out of crypto. Repeat in 2020, 2021. Everybody's, oh, the dollar's going to crash this time for sure. Have you seen what the Fed does? Have you seen what the federal government has been doing? And everybody piles into the crypto assets because the dollar's going to crash. And this time for sure. We're telling you it's going to crash. You'll just wait and see. But then it doesn't. The dollar starts to level off and continue higher. Then, of course, later in 2021, and especially in 2022, the dollar starts to skyrocket. And everybody says, well, wait a minute. We were told the dollar was going to crash. It's not crashing. It's doing something the opposite. No, by the way, we just did this a couple of years ago. Suddenly, not as many people are interested in cryptocurrency anymore. So for my own personal view, a short run cryptocurrency, I think, again, has that. They have the placebo effect in mind. They have this idea the Fed has devalued and the federal government together have devalued the dollar. But you can never square that circle because the dollar never goes down. It only goes up over time. And so you have this influx of interest into crypto and then this outflow of interest into crypto. So short run, you have this massive volatility in price, which is not what you want from a competing or an alternate currency system, which has kind of opened the door to other forms of crypto like stable coins, which to me is really what's going on in cryptocurrency and digital currencies and DeFi and everything else has nothing to do with store of value. It's all about medium of exchange and elasticity.
I do not fully subscribe to Jeff Snyder or Brent Johnson's theories about the Eurodollar system. However, Jeff has some informative opinions on this. The Eurodollar system is every non-US bank that is holding dollars or debts denominated in dollars. These banks are not subject to the same regulations as US bank and therefore can take more risk. This Eurodollar system is opaque and there are no regulators that police this system, so there can be a lot of issues with it. These banks take the dollars that they have on their balance sheet and 10x leverage them due to fractional reserve lending. When the Fed raises interest rates, all of the bank's debts are being squeezed, and there becomes a dollar shortage. This is why the DXY is climbing higher and higher, because banks are desperately scrambling to find dollars to pay off their denominated debts before they become more expensive. This Eurodollar system is opaque and unregulated. Jeff states that crypto's true innovation is a medium of exchange. If we were to apply digital assets to the Eurodollar system, many of these pitfalls will be addressed, especially with utilizing public ledgers. With high interest rates, the cost of moving money is going to grow exponentially. The downside is for crypto is the liquidity gets sucked out while high interest rates are in effect. So there's less money that can be moved through crypto rails.
I'll tell you why I say that. One, when I was the Undersecretary of the Treasury Department for Terrorism and Financial Intelligence, and I would travel all over the world, it became increasingly clear to me that our banks had massively de-risked in the developing world and emerging markets. And why do I say that? Well, because if you meet with any senior official in the developing world or CEO of bank, they will tell you the same thing, that our banks have massively de-risked, and importantly, that there is one country that's come in on the back end to take advantage of that, and that's China. And so in many respects, we are really in this massive global competition all over the world for the future of our financial infrastructure. And you have to ask, if our banks are de-risking, who is going to take over that financial infrastructure, and what is that going to look like? I believe that much of that is going to come from disruptive financial technologies like crypto, like fintech, and the country that captures the talent that's building out these really fascinating financial rails is going to find themselves in the next 3 to 5 years very much at the center of our global financial infrastructure.
Banks base all lending costs on risk. Will you get your money back with interest? If not, you won't lend out your money, or you will for a much higher premium. Think about the environment I just described. It becomes very risky. With higher interest rates, therefore, every bank in this system will charge more money in order to function. The correspondents are just backing out of jurisdictions completely. This means money cannot flow to these banks because it's too risky. Ripple's ODL can move billions of dollars for much less, as well as they can lend to banks. I suspect this hiccup in monetary policy will cause many banks in illiquid and high-risk areas to join RippleNet.
System, and I think I'm right about this. In fact, I'm really sure I'm right about this. Since 2007, is we have a shortage of money. We have an inelastic currency system. Historically speaking, whenever you have an inelastic currency system that doesn't supply the money that the economy needs to grow and be efficient, competing currencies will evolve because human beings are ingenious. And digital currencies in the underlying basic fundamental capacities are ways to solve this inelasticity medium of exchange and have nothing to do with store of value. So you have these competing tensions where digital currencies are evolving toward a medium of exchange that's useful in parallel or in competition to the Eurodollar system, but investors are taking the placebo and running with it and running wild with the cryptocurrency prices, which is sort of not what's going on in actual, the development, the technology and innovation in the crypto space. So you have one thing that's sort of a long run trend where digital currencies are trying to solve elasticity in the medium of exchange, where investors and speculators are running into cryptocurrency on the other side because they wrongly conclude that crypto is about store of value when it's really not. And that's so long run, I think there's value there. The long run, there's potential there, even though the prices have been extremely volatile and wild. And I think that, current prices in crypto are way overvalued because we don't really know what that elasticity solution might look like when we get to the long run.
Jeff is saying there is a crunch in the Eurodollar system where there's not enough dollars and money cannot flow through the economy as needed. The true innovation behind crypto is a medium exchange, being able to send money as easy as it is to send an email. When money or value is tokenized, its properties act very differently than assets and liabilities on a balance sheet and can be used differently. The store of value narrative behind crypto is fundamentally wrong. My personal view is that with the high amount of utility on a crypto asset network and constant demand for that mainnet token, this will create a network that sustains its value. directly tied to the amount of use that the network has.
None of it will happen overnight, but if you look out over 3 to 5 years, then the conventional banks, Europe, UK, US, who are taking deposits and making loans and want to keep this, corporate treasury type of business, are going to have to cannibalize and adopt digital. If they don't, they will fail. And I think people are beginning to accept that, but what they haven't accepted yet is it's equally true on the other side. For Circle as an example, for them to succeed, they have to embrace regulation and probably become regulated banks. And that's not kind of in the market yet for most crypto firms. So we are very much applying to become a regulated bank. And I think there's going to be a lot more regulation needed, smart regulation on the digital side. And I think there's going to be a real cannibalization of the infrastructure on the legacy banking side.
The big banks are going to plug into crypto rails, and if they don't, they will fail.
You press a button, and now we can send email to everybody 24/7, 365 days a year. Now, that infrastructure, very few institutions will decide to become front runners and take advantage of it. And it doesn't matter, it's a fintech or a bank, but institutions that do, they will become the next Amazon, Facebook, Googles of the world, and everybody else will be left behind because they will get a dominant market share based on this new infrastructure that is getting created. I used to work 15 years at traditional financial institutions, and large business in a traditional financial institution is the ability to manage this mismatch. Bob sent me money in UK time zone, I'm receiving it in the Philippines time zone, and the only reason the institution exists is because we are in 2 different time zones. Now, if that is not there, then a lot of business models itself will become irrelevant. And that's something to watch out, but also the opportunity is huge to essentially, like he said, in this fragmented space, to essentially consolidate and bigger companies to emerge.
Middlemen will be removed, and by removing middlemen that tax everything that goes through them, the friction and costs are removed.
Don't see the money themselves. It goes through regulated entity, but they become the front end of it. And that allows them to provide services at a much lower cost than a number of the current legacy players, if you will. Believe it or not, there are some legacy players that simply do not want, which is one of the other challenges, I think, do not want to believe that these technology companies are actually a threat. And so they stay on course, and I believe that they will go extinct over time. Technology is disrupting every sector, as Catherine said, but it will definitely, and it currently is. There are many examples. Circle is one of them, many others that we currently use, and this is just a fraction of what will. I think the fintech now takes 1% of total addressable market of the financial services. It will take a lot more in the coming years.
Apocalypse has come and gone when we're just grubbing in the ashes. Thanks everyone, I hope you enjoyed the show. Please take a moment to like and subscribe and comment down below. If you enjoy work like this and wish to support my channel, please consider joining my Patreon.